Hello, I'm Bernard Hickey with the Daily Briefing from interest.co.nz. Today we'll look at the latest fallout on global capital markets from the Bear Stearns collapse. Now, the Federal Reserve wants to have much deeper oversight of investment banks. And we'll compare America's housing market with New Zealand's and ask the question, is our housing market going to fall as much as America's has? That in a moment. But firstly, we look at the latest announcement from the US government about the global credit crunch. 10 days ago, the global financial system stood on the precipice of a complete meltdown. The likely bankruptcy of Bear Stearns threatened to infect the banks it had dealings with in the massive markets for credit default swaps and other bonds. Essentially, the US Federal Reserve stepped in to rescue the global financial system from a meltdown. It took drastic action. It did things it hasn't done since the 1930s. Firstly, it engineered the sale of Bear Stearns to JP Morgan for $2 a share, when it had been trading at $60 a share only a few days earlier. Then it opened its discount window to investment banks. This means it offered to lend them valuable and safe Treasury bonds in exchange for mortgage-backed securities that the investment banks wouldn't trade with each other. This was unprecedented. Previously, the Fed only opened this window for federally insured deposit-taking institutions, which means the banks. Now it started lending to brokers too. It hasn't done that since the Depression. But there's a price to pay for that, and now it's coming. Increased regulation. Treasury Secretary Henry Paulson said overnight in a very interesting speech that the Fed would need to have much more oversight of investment banks. He said it is already working closely with the SEC, and that's America's financial regulator, to hunt through their books for signs of stress and failure. That should be a revealing exercise. So what does it mean for us? I suspect it means investment banks will become more careful and less imaginative with their sales processes and their products. That could mean fewer fancy instruments that in the short term have the effect of lowering interest rates globally, which means long term we're talking about slightly higher interest rates. We'll see. Investment banks and brokers aren't regulated by our Reserve Bank, and we don't have a situation similar to Bear Stearns. But where should we? I'm sure the Reserve Bank is reading that speech from Henry Paulson very closely. And now for another look at house prices and how our downturn in New Zealand compares with the US housing downturn that has got global financial markets in such a mess. Put simply, we're nowhere near as badly off as the market in the US, but we could end up in the same place eventually. Firstly, just how bad is it in the States? House prices there fell 11.4% on average over the last year. Futures markets are predicting they'll fall another 13% this year. So all up, US house prices could fall a good 25% before this is all over. The stress on homeowners and investors is intense. Last year there were 1.5 million foreclosures, what we'd call here mortgagee sales. That's more than double a normal year. This year an estimated 2 million homeowners will be foreclosed on. That's about 1 in every 100 households. There are about 8.8 million homeowners in negative equity now in America. That's about 5% of households, and you'd have to expect that will double or triple before this is all over. And here's the stat I found most stunning, which at least partially explains that high number of homeowners in negative equity. Last year, almost 30% of the home loans written in America were 100% home loans, which means no money down, as they say in those infomercials. So how does this all compare with us here in New Zealand? There's a couple of big differences. The Americans are just excellent at building lots of homes cheaply and fast. That means supply very quickly pushes prices down. In some states, they just whack up a new suburb somewhere on the prairie pretty much as soon as they feel like it. Here we have so much red tape around building new houses and suburbs, and we're so poor at building the infrastructure for those new suburbs that our supply of new housing has actually fallen in the last couple of years. Secondly, there wasn't nearly as much reckless lending here as in the States. We don't know how many 100% home loans have been written here in the last couple of years, but I'd be surprised if it was more than 5%, not the 30% seen in America. I doubt we have as many subprime borrowers either. That's mostly because our banks do the lending themselves directly, and can spot a dodgy borrower pretty quickly. In America, much of the lending was done by intermediaries such as brokers, and then the debt was sliced and diced up into securitized parcels, which made it very hard for the end buyer of the mortgage to know the borrower. They simply relied on the AAA credit ratings given to these mortgages. Boy, was that a mistake. So what might happen to house prices here? They're already down 4% from their peak. We think they have a long way to go yet. That's mainly because our housing is so unaffordable relative to our incomes and even relative to other markets. Remember, affordability in America is actually much better than in New Zealand, and their prices are falling, and therefore they're more sustainable than even here. The Demographia survey of affordability released earlier this year found New Zealand was about twice as unaffordable as America. To give you an idea, the median house price in America has just dropped under $200,000, which is about 250,000 New Zealand dollars. Our median house price has just dropped to $337,500, and our incomes are about 40% below those in America. Our prices are still way out of whack. We think our median needs to drop to around $250,000 to become affordable, which means prices here have another 25% to fall. On that cheery note, I'm Bernard Hickey from interest.co.nz with the Daily Briefing. We'll see you on Friday.